Hello and welcome to today's webinar, Digitalization in Challenging Times, How Your Finserv Company Can Stay Competitive and Efficient. Thanks so much for joining us on the webinar today. This event is presented in partnership with our friends at Split. Before we get started, there's a few things that you should know about the format of the webinar. First off, my name is David Davis of Actual Tech Media, and I'll be serving as the host. We want these events to be educational, and we encourage your questions there in the questions pane of the audience console. We'll be doing a live Q&A session at the end of the event, so keep those questions coming. We also have a best question prize, which I'll talk about here in just a moment. But first, I want to call your attention to the handouts tab. It's there that you'll find a link to book a demo with Split, to start your free 30-day trial, as well as the Finserv ebook and the WePay case study. Those are all excellent resources I encourage you to check out here during the event. Make sure that you spend some time to book a demo with Split, and I think you'll see how valuable this solution can be for you and your company. At the end of the webinar, I'll be announcing the winner of our Amazon $300 gift card. If you're watching this on demand, recorded, of course, the drawing has already occurred. The prize terms and conditions can be found there in the handouts tab. And then I also have a best question prize for an additional $50 Amazon gift card. This is for the person who posts the best question here in the questions tab on the live event. We'll be contacting the prize winner after the event via email. All right. And so with that, I'm now excited to bring in today's expert presenters. Ariel and John, it's great to have you on. Take it away.
Thank you for having us, David, and it's great being on one of these again. Happy to be here one more time. So today we're going to be talking about digitalization in challenging times. So how your Finserv company can stay competitive and efficient. To introduce ourselves, I'm Ariel Pérez. I'm the VP of Engineering for Experimentation and Measurement at Split. I'm in charge primarily of the area of the house that focuses on metrics, impact, measurement, experimentation, and powering your feature flags and powering your learning through data and that powerful combination of feature flags and data. My team's focused on building that stuff out. Here with me, we also have John, our CFO. So John, over to you.
Thank you, Ariel. Hello, everyone. My name is John Cappelletti. I'm the Chief Financial Officer of Split, and I've been with the company for a little bit over 4 years. And my focus is really in finance and operations, and my background has been across both, Fortune 500 companies as well as startups. And with that, I'd love to dig in, and maybe what we'll first talk a little bit about is, the state of the economy. As I think we've all sort of read in the headlines and have also experienced, is that the economy is shifting, right? And before we talk a little bit about what we might expect to see in 2023, let's maybe talk a little bit, go down memory lane and talk a little bit about, well, how did we get here, right? As we step back to, the financial crisis of 2008, after that crisis, we had a really prolonged and relatively stable economic growth. Over the last 10 plus years, we had interest rates that were near zero. Since 2009, we had gross domestic product, for instance, was growing relatively, in a stable manner from about 1.5% to 3%, year on year. Unemployment rates were falling from a high of around 10% back in 2010 to less than 4%. Right, in 2019. So that's basically at full employment. And you also had inflation, right? That was a plus or minus 2%, in that 10-year period. And so when you kind of look back at that era, it really was in a way sort of what they call a Goldilocks economy, where you have stable growth, low unemployment, and low inflation. And in that era, there was, relatively speaking, a low cost of borrowing. You had relatively cheap money. And what you ended up seeing is that investors were chasing, yield and investing in more riskier assets. So you saw valuations, for instance, increase. across all asset classes, both equity, stocks, as well as commodities, real estate, and crypto. And then the pandemic hit, right? And that had a profound impact on, demand versus supply in the market. And so you had effectively demand dropping off of a cliff. And with that, both the monetary stimulus that we saw from the Fed, as well as a massive fiscal stimulus, was injected into the economy to address that hole in demand. And from that, you saw asset prices inflating as the cost of capital was cheap. And as the economy reopened, that demand overwhelmed supply. And that's where you saw supply chain bottlenecks, labor shortages, commodity price increases, as well as the war in Ukraine really drove an acceleration of prices. And you saw that inflation really start to take effect. So here comes the Fed then, right? And they have two mandates. The first mandate is to drive full employment. And the second one is to control inflation. And that's where, they really started to get aggressive with increasing interest rates in order to address inflation, right? And with that, we saw that the cost of borrowing increased, right? Money was no longer cheap. And what we've seen from that is an impact on the stock market. I think we've all seen, the hit, perhaps in our 401ks. The S&P has been down around 17% year to date. We've seen tech valuations, down significantly. Many of those, tech companies are below their IPO levels from the prior year, and it's been a difficult fundraising environment. And the Fed has hiked, interest rates 7 times this calendar year. Most recently yesterday, where they increased interest rates 0.5%. And the reason why is that although we are seeing, inflation start to ease, it's still quite stubborn. And we see it every day, right? As I looked at, some interesting data points, the price of eggs is up 49% from a year ago, milk up 15%, electricity 14% up a year ago, the price of chicken up 12%. Which is actually kind of interesting. The price of eggs is up 49%, but the price of chicken is up only 12%. If somebody can explain why there's such a difference, I'd love to know. But that being said, we are seeing, prices increase. And we're seeing sort of real average hourly earnings effectively flatter down, year over year. So as we sort of see that shifting economy happening in 2022, what can we expect as we enter 2023? And looking ahead, I think, there'll be a couple things. You'll see growth slowing. There's quite a bit of consensus around a recessionary environment. As we head into 2023, we'll likely see, unemployment increasing. And we're already starting to see that a little bit in certain sectors like the technology sector. Where you're seeing a lot of headlines around layoffs. And what you'll end up seeing is a bias of companies towards profitability. So it's no longer going to be a growth at all costs type of environment. And with that, you'll probably see, earnings revisions, downward revisions on earnings expectations. You'll see budgets scrutinized, which is really kind of a key topic for today, which is, okay, you've got a project that you believe is going to have a real impact on your business. And it's going to be super important, those projects that are going to drive either cost savings, accelerated innovation, reduce risks, or drive impact to your top line or your profitability. Those are the ones that are going to get support, right, from not only your CFO, but the business at large. And with that, I think we'll end up seeing is certain sectors are going to be more resilient, right, than others. And one sector, that we believe is going to be pretty strong in this environment where you have interest rates increasing is the financial services sector. And in Fiserv, that is an area that spends a lot of money on technology. They're approaching roughly $100 billion per year of spend. And we also are seeing, the big banks spending a lot. So they are driving a ton of investment. As an example, J.P. Morgan Chase, announced recently that they're going to be spending $12 billion on technology. So one of the things we'll talk about is, well, what are they spending their money on and why, and how you can, work with your company to be competitive in that space. And before I'll turn it over to Ariel to get his perspective on, what are the trends happening in financial services sector. I'd like to do a quick poll and hand it back over to David and get a sense of, from the audience as to, how much does your company spend annually on IT relative to some of these big banks?
Absolutely. Yeah, I want to call everyone's attention to the poll that's on the screen. You answer right there in the slides window. Just select the option that corresponds to you and your IT spend at your company. There are hundreds of thousands, millions, hundreds of millions, or billions. This will be interesting because I'll share the results of this here in just a moment, and you can kind of see how you stack up with your peers who are on the event, and also, the big banks that John was just talking about. So I'll give everyone a moment to answer this. I see a number of responses already. Thank you for those. Let's get just a few more. All right, excellent. Thank you for all the responses. We'll have a few other polls here coming up in the event as well. And if I share out the results, it looks like 44% said hundreds of thousands, 44% said millions, and 7% said hundreds of millions, 3% said billions. John, what's your take?
Probably a little bit of what I expected, in terms of most companies are not spending at the level of for instance, a JPMC spending in the billions. And all the more reason why, we'll go into, well, how do you stay competitive against some of those big banks? And with that, maybe I'll turn it over to Ariel and get his perspective on what are financial services companies investing in and why?
Awesome. Thank you for that, John. So yes, I mean, $12 billion is a lot of money. And, people can ask themselves, well, where is all that going? And how do you know that it's being well spent? Obviously, when JPMC first announced that, I know that investors and the markets were immediately questioning, hey, is this the right decision? I think, thankfully, we've seen the CEO be able to explain that very clearly and well to the market. It's what you need to stay competitive. And well, where does it go, right? So there are many places where this goes. I mean, obviously, the first part is these are big places. Just keeping the lights on is a big bill, and these are things like keeping your existing systems running, operating them, but also and I consider this in the keep the lights on bucket. Just even improving the efficiency of those existing systems, tweaking out optimizations, and making sure that they're running as effectively as possible. There's also, starting to migrate to the cloud. While, I don't put those in the bucket of innovation, those are things in just how to keep up with the Joneses these days. And it becomes more and more part of just the core and keeping those lights on, but moving to the cloud, become more efficient, ideally prep you to become more nimble, improve your resiliency. They're also investing in new systems and upgrading their infrastructure, again, maintaining the house. And that alone is a big part of the budget. But that's not really where they're focusing. And actually I'm going to take it back just 2 slides. Sorry about that. I'm going to keep it here. But they're really investing on how do they differentiate from their competitors, and how do they innovate, right? On one side, you've got fintechs, smaller companies, startups, nibbling at their heels, right? Coming up with new ideas, new ways of engaging, and moving really fast. And keeping, to a degree, keeping these big banks on their toes. On the other side, you've got powerhouses, the FANGs, that are encroaching in what used to be a traditional safe financial services space. And what makes that interesting is the fact that These FANGs have a DNA, a culture of innovation, of moving fast. They've honed their processes and their tooling and the way they think and the way they work to really move fast and take advantage of opportunities as quickly as they appear. They have lots of cash, even in today's market, even in today's economic climate. Many of them are still sitting on mountains of cash ready to be deployed. The other piece that that financial services also understand is that these FANGs and even the fintechs are a lot less regulated, so they can move a lot more quickly. They can move with a lot less restrictions. So banks know that because of this, they have to heavily invest on differentiation and innovation because they're getting hit from every direction and feel a little bit constrained when it comes to how they do it because of the regulations. So where do they focus to really differentiate and innovate? A key thing that we're seeing is that to a degree, financial services is becoming a little more commoditized, where, a checking account at one bank is just like a checking account at another bank and my savings in this bank. So how do banks compete these days? Especially in a market where growth growth at all costs isn't the biggest thing, and in a market where maybe you have to pull back on your spend, they're really investing on customer experience and on service delivery. That's where you differentiate. So what does that look like? One big thing that we saw, and it aligns with one of the things here on the bottom, is that COVID vastly accelerated digital and mobile adoption. So now that our customers, our target markets, are much more comfortable with mobile and web and just digital technologies, and interact with you as a business primarily through digital channels now, this is where these companies are investing, and they're investing heavily on how to improve that experience, how to make that experience seamless. They're also improving their ability to service these customers across any channel, whether omni-channel, cross-channel, but being always on, so that customers have access to their accounts, to their financial statements, and can service their needs anywhere, anytime. So that means that they must be available and have a seamless transition between the physical world, my mobile device, the ATMs, the branch experience, the credit card experience, the shopping experience. They need to be everywhere all at once and be on, and it has to be a seamless experience. So heavily investing on experience, on making this seamless. Other areas where they're investing in are things like, getting really good at fraud and risk management, right? One of the things that financial services firms can do for you is really help you make sure that your money is there when you need it and somebody else isn't spending it. So they're investing in technologies that allow them to provide a better fraud experience, a better risk management experience. And a lot of these things are heavy investments in machine learning and artificial intelligence to spot things that look out of the ordinary, things that look out of place, to reduce that need to ask you, hey, was this you? If they can get better at understanding how you behave, they can get better at understanding what things look like it was you or wasn't you. They're also investing heavily, partnering with these fintechs. Yes, the fintechs are nibbling at their heels, but it doesn't mean that they're the enemy. In many ways, these banks have these massive cash hoards, and they're using them to not only integrate to these fintechs to accelerate the ability to deliver some of these differentiating capabilities, but they're also investing in these fintechs as partners, building out those technologies and really see if they work out. These become test beds for new ideas that become a low-risk way of testing out new ideas. They're experimenting with these fintechs to eventually determine whether they integrate them completely or not. Another area that banks are investing in these days is, and this comes a lot from this challenge from the FANGs, is they're trying to get better at facilitating commerce. So you might see places that some banks are buying companies that aren't in the financial services, might be buying travel companies, might be buying restaurant companies. And at the end of the day, it seems like they're working on how to create a cohesive end-to-end experience and be with you along every step of the journey. When you're trying to make a big purchase, a small purchase, they're there to help you make that purchase and make it better for you, and then make it easy for your funds to be available for that purchase. They've also been investing in some, a little more on the more innovative side on things, blockchain. As much as maybe certain banks might talk negatively about cryptocurrencies, they're also bullish on the blockchain itself and what it can do, primarily when it comes to facilitating and simplifying settlements, right? These days, it's amazing that in today's age, I trade an equity and it still takes me 3 days to settle that, right? So things like that, improving settlements with blockchain, moving money more efficiently and effectively using blockchain technologies. They're investing in that, so again, to improve that experience, to make things settle faster, to make it easier for the end user. And even they're investing, whether it's 5% of their time, 1% of their time, they're looking further out, right? Even things like quantum computing, that might seem like the realm of physicists. It might seem like the realm of like the Googles and the AWSs, but there's a lot at stake when it comes to, being ahead of the game when it comes to quantum computing. At the minimum, protecting yourself from things that will change the quantum world, like encryption technology, but also figuring out what innovative new solutions they can come that can come from being able to harness the power of quantum computing.
Yeah, and it's interesting during, it might seem counterintuitive, but during an economic downturn, it's often the best time, right, to invest in transforming your business, as many of these large banks are doing. Ariel, what are your thoughts on investing in tools and people now?
Thanks. And yes, there's a lot actually that you can be doing now. And again, it seems counterintuitive. You're right. The biggest things I think that you can be investing on right now is optimizing your bottom line. You start there, right? There's ways to think about how to optimize your bottom line. Like you work on where are your costs coming from. Are we the most productive? What can improve our productivity? And how can we be more efficient, right? The reason to focus on these things first, I think, is as John alluded to before, growth at all costs is no longer the way to grow, and people want to look at that. You have sustainable, scalable growth, and efficiency is a big part of that. So focusing on efficiency is huge, and there's certain metrics, and there are big metrics here that you can look at, and I'll talk about those in a bit. But the main reason to focus on efficiency first is that with that kind of investment, you can actually see it pay for itself faster. So if you hit the bottom line, the investment in the tool or the people, the processes pays for itself, buying you a lot of room for many, many other interesting things. And it takes certain skills. You have to develop certain skills to get really good at moving these metrics. So first I'll talk about the metrics themselves, right? And this is not an exhaustive list. You might want to focus on your retention rate for your customers, right? And this is because it's easier to keep a customer than it is to acquire a customer. And it's also a lot more expensive to acquire a customer. So working on what you can do to fix the bottom of that bucket and that leaky bucket has massive payoff and returns. Looking at your cost to serve, how do you figure out that right mix of digital tools, physical tools, and different servicing capabilities to vastly improve your cost to serve? Digitalization goes a long way in that. Looking at your lifetime value to customer acquisition cost ratio, right, is how good are we getting at reducing the cost to acquire the customer, and at the same time, how good are we getting at increasing the value gained from each of those customers, right? That ratio really helps you figure out, are you doing a good job at that? Failed customer interactions is one that many people might not have looked at or thought about, but that's really a major experience one, right? It's every time a customer tries to do something, did they fail? And even the simplest way to look at this is, how many errors are they seeing when they try to complete a transaction in your application, right? That's a failed customer interaction, and that has many downstream effects on how a customer perceives you and a massive impact on experience. And then lastly, I'll mention average revenue per user per account, right? That helps you maintain the top line idea of it. Are we getting better and better at improving how much revenue each customer generates? I highlight these because when you look at these metrics, and I really want to talk about metrics, the muscle that you build during a downturn is what are the different things I can do to move each of these? What are the practices? What are the skills that allow me to make sure that I can incrementally and continually create a movement in each of these? There's practice in accelerating how you're learning, accelerating how you're deriving insights, continually testing, validating, experimenting, and seeing which things move metrics, which things don't move metrics, so that you can maximize the value at the end of the day out of every single decision you're making. And the key reason to do that now that we're in a downturn, is if you get really good at optimizing your efficiency metrics, optimizing your productivity metrics, you get at least two things out of that. One, that skill set, the skill set that it takes to continually move things, continually test things, continually validate. But like I said before, it starts paying for yourself. This investment starts paying for itself. And then when we do come to a turn in the market, when the market finally improves, not only are you in the position to scale faster and more quickly because you're a much leaner shop, but you've also built those skills that are necessary to then say, great, how do we optimize the top line? How do we optimize revenue? How do we optimize for the things that allow me to grow and grow faster? Because you've been building that skill set throughout this entire downtime, focusing on costs. Now you're going to focus it more on revenue, on gains, on acquisition. And this is what you're working on, and at some point, you're going to have to be able to get somebody to invest in this, right? So the key thing that you're going to be learning through this space is how to get more efficient, right? How do you deliver faster? How much risk am I reducing? It's important to keep thinking about these metrics and the things that are helping us, because that'll make that conversation with your CFO much easier. And with that, I'll hand it over back to John.
Great, thanks, Ariel. All right, so I'm going to just cover, real quickly here is what are the top 5 things to get your CFO support, right? And CFOs often don't like to be surprised, right? And we often, don't like to say no all the time. We'd like to say yes, but there are things that you can do to get the yes, from a CFO. And it's really in 5 areas, 5 major areas. The first is when to make that ask, right? So there's a natural cadence to a company in terms of how they plan and how they invest, right? And so you have natural sort of in planning investment cycles in your particular organization. Often companies they have what they call as an annual operating plan, where they're setting the priorities of the company, expectations on how they're going to grow, what areas are they going to make investments in. And that annual operating plan oftentimes will get revisited, throughout the year. Typically halfway through the year, they'll take a look at how are we progressing against that plan, and are there any adjustments we want to make. So you want to kind of get in front of some of those planning cycles. And also, if you're a public company, in past experiences, I've had to give quarterly guidance to Wall Street, right? And you're kind of setting expectations of, how much you're going to be earning from a revenue standpoint, what your profitability is going to be, and once you're making that guidance to Wall Street, those investments have already been locked down, right? So it's often very difficult to get investment approved after the fact. So just keep in mind as to what your cadence is with inside of your company in terms of planning, and get in front of that. That's the first one. The second one would be is really focus on what are those metrics that you're going to impact, right? Ariel mentioned a number of those metrics that are extremely important. And so if you're going to be impacting, for instance, the top line of revenue, identify what those investments are, whether it's a conversion metric of free to paid, as Ariel mentioned, retention or revenue per account, or even a metric around, how much you're going to potentially reduce, downtime of your application that has a direct impact on potentially revenue, right? Are you reducing infrastructure costs, right? What is that metric that you might be, impacting? That might be your gross margin, or your gross profitability, or are you increasing, for instance, your software delivery cycles, per engineer? That might end up manifesting itself in a lower engineering, research and development operating expense as a percentage of revenue. So really keying on those metrics is going to be great. Obviously, a discrete investment in quantifying that is going to be really important. How much is it going to cost, in terms of headcount, whether it be headcount or programmatic investment costs, are they one-time costs, or are they going to be ongoing? Just having a real clear quantification of that investment is going to be very important. And then also the return. When do you expect to see that return play out, right? And for how long? And the one thing I'll just convey to the participants is the way that you can convey how those metrics ultimately impact the financial statements. And I'll talk a little about financial statements here, but really identifying how you're going to impact the financial statements is going to be hugely critical, right, of getting the CFO's buy-in. So what are those financial statements? So you've got your income statement, often also called a P&L or profit and loss, right? And that's basically describing as to, what your profit and or losses are for your particular company. So, would be akin to how much personally you're receiving in terms of, earnings, and what your expenses are. And are you actually driving profit relative to, your earnings and costs, or are you driving a loss? Your cash flow statement would basically just be monitoring what are you spending and or earning in a particular period. So a case, it'd be akin to, let's say you have a bill that you receive, personal finances, you incur that cost, in December, but you don't pay out that bill until January. That cash flow statement basically just monitors when is cash coming in and when is cash coming out the door, right? And finally, your balance sheet is really a snapshot as to what are your assets versus your liabilities and your equity. So this would be akin to your assets in personal finance would be potentially how much cash you have in the bank would be an asset, right? A liability might be your mortgage, right, that you're paying down, and the equity could be potentially the equity that you have in your home, right? And so similar to your personal finances, a company will have their own sort of balance sheet or snapshot as to what their assets versus liabilities and equity is. So really understanding what metric you're going to be driving, how that's going to ultimately impact the financial statements is going to be really important, right, of getting your CFO's buy-in. And with that, why don't we pause and I'll kick it back over to David and we'll have our second poll question.
Absolutely. I just brought up a poll on the screen for everyone out there. The question is, if you can impact an area of the financial statements, what area would excite the CFO the most? Is it revenue, gross margin percent, net income, cash from operations, total assets, or total assets? Those are the options there on the screen. So could be tough. You got to pick one. What is the area that would most excite the CFO? I see some responses coming in. Thank you for those. Let's get just a few more. And I think these are great questions for technology people to think about, because being a former IT manager myself, we might not spend as much time thinking about our impact on the financial statement as much as we think about the technology. So these are good things to think about. All right, lots of good responses coming in. Let me go ahead and share the results. And the leader here is net income at 37%, followed closely by gross margin percent. John, what do you think?
This is interesting, right? And I guess what I'll say is it really depends. And so the answer is there's not one specific metric that will excite the CFO the most. It depends, right? It depends on the company. But it's not surprising to see that net income is sort of hitting the top of the list, right? If you were to sort of rewind maybe a few years ago, revenue might have been the leading metric that most people would have identified, because that was an era where more value was placed on growing your top line. Whereas today, you might be looking at, well, we want to actually drive profitability, and net income on your income statement, your P&L, is what is, at the end of the day, what is your profit, right? But it's really going to depend on the company. So if you're a very large Fortune, let's say Fortune 100 company, you might be really focused on driving net income and earnings, because your top line is relatively stable and predictable, and you're really trying to drive efficiencies. You might be another company where actually, your spending is roughly in check, right? In terms of your operating expenses, you're hitting your revenue numbers, but your gross margin, so the cost to serve your product, is really an area that has the most opportunity, right? So it really depends on the company. But I think this is interesting to see, where sort of the mindset is now shifting, right? It's shifting a little bit more towards profitability and less at growth at all costs. All right, and so with that, maybe we can go back to this slide, and I'll turn it over to Ariel, because I'd love to get, you've received sort of the CFO's perspective, right, on how to get buy-in. But from your experience, Ariel, what have you done kind of in your career to help get the CFO's buy-in?
Awesome, thanks for that, John. I think, this is hard, as I think even David mentioned, for technologists, it's not a skill that we tend to learn or practice, meaning speaking about the end business impact of our technical changes or technical work often is because the metrics that we move are usually at least two levels removed, right? You might think about business outcomes, step back for a second, maybe product outcomes impact business outcomes, and then product outcomes are impacted by technical outcomes. Often that's usually the way we get to business outcomes, although there are other more direct ways. So, it's not something that we get to see very directly, and we don't get to, practice this muscle and exercise this muscle. But I think the simplest thing that I can suggest as a way that's helped me in the past is, you know, leverage ROI calculators, and ROI calculator. Let's say I want to bring in a new product and I believe that this product will impact a set of metrics. Often those vendors might have their own ROI calculators, whether it is on their own website or something that they provide you when you're working and talking to their sales teams, because they do it themselves, right? They want to help you see the value. Leverage those. Those will really help you figure out, punch in the right parameters, and give you an idea of what the ROI will be to facilitate this conversation with your CFO. You can also, at the end of the day, your business is different from other businesses, so you can potentially build your own ROI calculator, especially even if you focus on the things that you know best: technology, building technology, maintaining technology, running technology teams. It's amazing how many costs build up there very, very quickly. And in the simplest term, sometimes you think about how many minutes am I going to save? If you have, 100 engineers and you save 5 minutes across those 100 engineers, and then do that every month for the year, that compounds very quickly, and engineers are very expensive. If you think about your operating costs, right? You can think about direct costs and what it costs you to run something. You can think about how many less people you might need to implement something. So headcount translates into dollars and cents at the end of the day. So there's still a lot, that you have at hand that is, more direct in terms of the way you work, that you can use to calculate and come up with a number on. This is the amount of financial impact we will have. So you can go and build out your own ROI calculator. And yes, there's also the initial cost for the particular thing you're looking to do, whether it's process or a new product. You can think about how long it'll take you to get value. Obviously, if you look at a freemium product, that makes it a lot easier, right? Let's start testing an idea with a freemium product. So that might also make it easier. But I think at the end of the day, the most important part that you need to remember and understand is this: you are not alone, and you're obviously not expected to be an expert on financial statements. That's why this is a partnership with your CFO. Your CFO wants to say yes, leverage them, and when you come up with your calculations, they'll help you review them. But there's things that they know how to do from an accounting perspective that you'll never have any idea about. So don't be afraid that if your number looks too big, that they'll never go for it, because they might be able to figure out more creative ways, saying, well, from an accounting perspective, we can realize these costs now, or we can realize these costs later. We can realize the income now. There are different ways to make that work in the financial calendar that I can't even, take a stab at understanding, but your CFO definitely does. So the closer you partner with your CFO, the better you can come up with an actual solution that works for both of you. So at the end, don't be scared to present something that looks too big. Lean heavily on the things that you know well and how you might impact numbers. And then that partnership with your CFO will help you understand other areas where you're not thinking about. With that said, I think, I want to move on to now another poll, because we're going to start talking about, assuming you get that buy-in and you're ready to go, you're still going to hit new stumbling blocks. And this is one of the biggest stumbling blocks. So I'll hand the poll over to David now.
Yeah, the poll that we just brought up on the screen for everyone out there, this is the last poll on the event. I want to call your attention to it. The question is, what is the hardest part of getting a tool adopted in your organization? Is it just the resistance to change? Nobody wants to move to a new tool. It's too painful. Is it risk aversion? Like we might have downtime or impact to our applications by moving to this tool. Is it, having people just understand the value of the tool? Or is it all of the above? This one, you can choose all of the above, but if there's specific option here that's much more applicable to your organization, then please select it. And we do want to get your feedback on this. I'll share the results here in just a moment. Let's get a few more responses. All right. Thank you to everyone who responded. Let me go ahead and share the results out. And it looks like a big winner here. 72% said all of the above, followed by 20% who said simply resistance to change. Ariel, what do you think?
I mean, this aligns very well. I mean, obviously, all of the above tells us that, look, these are big problems for everyone, and often all of these are the hardest parts. Like they're all very hard. But it's also telling that resistance to change is the one that most people identify as an individual one, and that's a massive part of implementing anything. Resistance, it's amazing how many people don't want to change for many reasons, whether they're comfortable, whether whether change is difficult, whether they don't know how to do it. That's one of the biggest things. Resistance to change is massive. So I think this aligns very perfectly with what I would expect. So I think now I'll transition over to talking about how do we manage change, because that's the biggest part, right? Managing change, it is a very difficult thing to do, especially the bigger and bigger your organization is. And it often doesn't even matter how much impact the particular solution has. It doesn't matter if your CFO agrees and buys in. It will not be successful unless you actually have, really strong skills and practices in implementing the particular tool, the particular process, the particular solution, because you need to get people using it. You need to get it to work. If I were to highlight, three particular things that really stand out to me in terms of helping this transition, the first one is if you find a solution that is very easy to use, that is self-explanatory and allows the people in the organization to self-serve, I think it vastly lowers that bar for how to get people getting value fast, right? So the easier to use they are, the more self-service they are, that means less investment, less time needed for handholding, less time and effort needed for training and education. Not that they're not needed, but a lot less, because people can figure it out and discover it on their own. And it's amazing how quickly people start finding value in new ways to use things when they use it more directly, are hands-on, and they find it very easy to use. The second thing that becomes extremely important is creating a culture of cheerleaders and fans. And what does that mean? You can't do it by yourself, right? The sooner you can identify who your internal champions are, the sooner you can identify the people that are bought in and really are gung-ho, and either A, will gain the most value from this, or 100% agree with your approach and this solution, the more power you'll have and the more leverage you'll have to really move this message forward, amplify the message, and test it in more places and really implement it in more and more areas. You really get to penetrate the organization by leveraging these champions and enabling them and empowering them. So that's a massive part here. Find these champions and then work with them to really amplify the impact. And the last part is, it's tied a little bit to the first one, is never stop experimenting. And this ties very heavily to the resistance to change idea and the risk aversion. It's important to couch many changes as an experiment, right? I think often when you introduce a brand new change, a big change, people immediately step back. No, that's going to be difficult. No, that's too hard. No, that'll have too much impact. But as soon as you say, hold on, wait, it'll just be an experiment, people tend to soften a bit, because they tend to connect experiments with the idea that, oh, it's temporary, it's small, the impact radius is minimized. So couching these changes as experiments and testing different ideas, different ways to implement, and the champions come into play here, allows you to, in a low risk fashion, try out new ways, try out what works for you, and do it in several areas so you can accelerate your learning on what works and what doesn't work, and leverage all those people while doing it in a low risk fashion. And what is an experiment? It's obviously something that has a hypothesis, right? This is what I think will come out of this change. It has an end date, and that's the big thing that really reduces that hesitance, the hesitation. It's only going to be for a month. It's only going to be for 3 months, and it has success criteria. And we expect that after the end of the 3 months, we're going to see these impacts. Couching it in those terms makes it easier to get buy-in from those people internally who are going to be affected by the change, and allows you to test the ideas in a low-risk fashion. Obviously, there are many other practices that you can put into place to really accelerate the implementation and the uptake, but these three ones really stand out to me. Now, once you start implementing, you start getting these in, The last step that I want to cover, and we talked about earlier on why would you invest now, and you're investing in the muscle on getting good at moving metrics. You're getting good at moving your cost metrics, your product metrics, your productivity metrics, your efficiency metrics. That all really hits the bottom line. These skills that you've learned, these skills that you've gotten, now actually prep you to really hit the top line, right? And what do you do to then accelerate your ability to affect the top line? These are investments that you make during this downtime and as you're coming out of it, um, primarily on enabling your teams to really run with this, to really run with these skills that they've learned, run with these capabilities that they've learned, and apply them everywhere, apply them to everything we do, how we do these things, so that they can better impact those top line metrics. So to me, the key things that stand out when you think about where to invest is, number one, providing your teams with autonomy, right? And again, autonomy is not just it's sometimes difficult for us to think about how to let our teams make decisions, right? It means letting go of some control, but autonomy, self-organizing, self-directed teams, teams that work with psychological safety. That means that they can try out new things. They might trip and fall, but there's a lot of trust that's built. When you give teams autonomy, it's amazing the kind of things that they come up with, the kind of ideas that come to play, and allows them to move fast and test things. And remember, they've learned these skills by optimizing for cost and efficiency. Now they're working on optimizing insights. They're optimizing new technologies, new solutions. They're optimizing ways of impacting the top line. The second thing that becomes crucial and absolutely crucial to enabling this is open access to data. Without data, without analytics, without the ability to understand where the problems are and the impact we're having, is very difficult to make the right decisions. So highly visible data and analytics shared across silos, right? Removing these silos, enable data-driven decision making, right? And as long as I can see my KPIs and I see my metrics, I see what things have moved them in the past, and I can see what's moving them now, that can only vastly improve my ability to make the right decisions and my ability to pivot when something's not working, because I can see it. It's amazing how much time is spent having to go to an external team, to an analytics team, to a reporting team to go get feedback. If that takes 2 weeks, it's very difficult to apply these changes. And the last bit here is, I think, a commitment to ongoing education of your people, continually training them, educating them, building and maintaining expertise, and committing to their personal growth pays off massive dividends, making them better at their jobs, making them better in the product, making them better at how they optimize metrics. All these things pay massive dividends when it comes to these teams experimenting with ideas and testing ideas. So with that, I'd like to, conclude and wrap it up and talk about, what we've learned and what came out of this. If you only take away 3 things, it would be these. An economic downturn can create opportunities for financial services firms and highly regulated organizations to learn and practice, how to move like these smaller, newer, more nimble organizations, right? These fintechs that are nibbling at your heels. How can you learn to move like them and then practice that skill of moving like them? At the same time, you don't want to be left behind in an economic downturn by these large orgs making massive investments. So if you learn how to invest like them, what are the right places to invest and where they're investing, that also helps you out massively here. And lastly, start today, immediately, now. Just like you think about investing, or even trees, the best time to plant a tree was 20 years ago. The second best time is now. Start today. Find what is the right solution for you, the right implementation for you. Look for freemium models if you can. Makes it much easier to implement, and because they allow you to take a look and get buy-in and implement them in your organizations. With that said, thank you very much, everybody. Thank you, John, for all the insights on understanding the financial background and what stands out to you. With that, I'll hand it over back to David.
Absolutely, yeah. Great presentation. I learned a lot. I know the audience did as well. We've got some great calls to action there on the wrap-up slide. I encourage you to check out. I also want to make sure everyone is aware of the handouts tab. Again, there's links there to book a demo, start your free trial. There's the FinServ ebook and the WePay case study you can all download here while we do our Q&A. So if you have a question, now's the time to get it in because we're kicking off Q&A now with this first question here that came in from Heath. He says, When spending to improve efficiency, the quality of money spent is more important than the quantity of money spent. Generally, what are the best areas that offer the best return on investment? Who wants to take that one?
Um, John, do you want to take that one or?
Yeah, yeah, happy to. It's a great question, Heath. Today, every dollar does matter, right, in terms of that investment, and that it's going to be, likely more scrutinized, right, in terms of where you're going to be placing that investment. As kind of back to that poll, right, asked where would you want to place those investments to see that return? Again, it really depends on the company and what aspects of the business model they are trying to improve the most. Okay. So that might be an area of driving more revenue. It could be on the gross margin side where you're trying to improve, your cost to deliver your platform, or it could be on your operating expenses. So I don't have a specific answer to you, but it would be good to reflect on, and ask your CFO, ask them, what aspects of our business model do we need to improve the most? What are areas where Wall Street, for instance, might be looking for you to make those improvements, to really give you, a potential to get, for instance, a higher rating from that third party, or a stock, recommendation. Whether it's a private company or a public company, every company has an aspect of their business model that they're trying to improve. So understanding that, you'll know where to invest.
Great advice. Here's another good one. They're asking, what if we have a tool in place, but we aren't utilizing it fully? How can we grow into our tech stack during this time? Ariel, is that for you?
Yep, I'll take that one. I think the first question is thinking about how self-service, how easy the tool is to use, right? And I think there is, trying to get more people to use it, and they'll learn more from it. But that's not always the case, I think. But often many companies have, amazing customer success teams, right? They have amazing LMSs and, self-service tools for learning, but also even guided training and stuff like that. Speak to your vendor partner, speak to the company that runs the product, and see what they're able to do here to, to facilitate enablement, to facilitate helping not only your existing users understand how to get more value, but also running training sessions and running seminars to help them understand the value, how to use it, and how to continually learn about it. I think the beauty of this is, if these companies offer this and it's part of the product, it's already part of the product. So get the value out of it, right? It doesn't mean that you're spending the time, you're not spending the money. You've already bought it. Leverage them, and that's what they're there for. So I think that's what I'd say to look for, if it's possible, if it's available for your product.
Excellent. And then here's another good one. How do we secure adoption within the organization if it's a large organization? They say, I'm good with getting my team up and running, but I can't secure universal buy-in to change processing overall. Any advice on getting buy-in?
I can take that one. I've dealt with this many times, having worked in the past, and I didn't talk about my past experience, but I've worked at massive organizations. Um, as many of you may know, in a large organization, things move a lot more slowly, for many reasons, right? One of the best tactics that I've seen work for me, and actually, no, it's more of a strategy, is um, working on two fronts, which is convincing the larger part of the organization that has to make the decision, that has to finalize that we need this and we should have this, but knowing that that's going to take them a year or two to implement. And that's just the reality of large organizations. At the same time, offering up the idea of, I'll be more than happy to be a test bed for this, right? Can you allow me the time and space to test it in my space, right? So we can prove that it might make sense at the larger org, while you're looking at what does it look like to implement, organization wide. If you let me be a test bed and validate that you run with it, what are the success criteria that you need to see, so that you feel like this is worthwhile pursuing, so that we can go and run with this. So that allows you to put it in their minds. You kind of create a reverse experiment. I'm saying, let's go try an experiment to change you. It's like, I'm going to be the experiment, but here's what you need to see in my experiment. And you kind of get a win-win, because you get to try the new thing for your team, run with it, but you also get to prove that it works, or prove that actually it doesn't work. So I think hitting them on those two fronts can go a long way.
Very wise advice. And this is a good one. Speaking of testing, what's a good first test to run to show a feature management system would work for us?
That's a good one. I would think that when it comes to feature management, in terms of a good first test, is just for showing that it works, right? That's a simple one. So what do I mean by that? Um, the ability to show that I can enable or disable something remotely without a deployment and see it in my real live app in someone's hands, that's massive, right? I think that gets you past that first hurdle of does it work? If you really want to see the best test, and here's a challenge in terms of it's not a test that you can force. And ideally, it's a situation that you don't want to occur, but it becomes a prime opportunity to prove its worth. Meaning, what I mean by that is, it's never let a good crisis go to waste. Is if you find that first example where something goes wrong, there's an incident, there's a problem in production, and you just show that I flip a switch and I disabled it and I immediately remediated that issue in seconds. That's that golden opportunity, right? That is that test that will show everybody this is worth its weight in gold. This thing works, and we can't imagine a world without this. The challenge with that is obviously you can't run that test, right? So you're hoping that it doesn't happen, but you're kind of also hoping that it does happen. The beauty of it at the end is that if it does happen, you can remediate very quickly.
I like it. It sounds like a great opportunity for a lot of companies out there. I think this is a great place to wrap up here. We're out of time in our webinar event. John, Ariel, it's been great having you on. Thank you so much for your excellent presentation today.
Thank
Thank you very
David.
much. Thanks for having us.
Awesome. And thank you to Split for supporting the event. Again, don't forget to check out the handouts tab there to book your own personal demo with Split or start a free 30-day trial. We also have a free ebook and case study there for download. So make sure you grab those assets here while you can. I do want to now announce the winner of our Amazon $300 gift card. This is going out to Michael Wary from Illinois. Congratulations, Michael Wary from Illinois. We'll reach out to you to deliver that. And we'll also reach out to our best question prize winner as well. Thank you to everyone who joined us on the webinar today. Take care, and we'll see you on the next event. Have a great day. Bye-bye.